All right, today we're really getting into the weeds on one of the most powerful and permanent decisions in all of estate planning. We're talking about locking in the generation skipping transfer, or GST exemption. And this isn't just theory, okay? We're going to be looking at the specific mechanics on Form 709, Schedule D. This is the exact form that can either protect a family's legacy for 100 years or, well, expose it to a massive tax liability.
So why is this such a big deal? It all comes down to this number right here, 40%. That's the flat tax rate for the generation skipping transfer tax. It is a brutal, brutal tax. It's designed to take a huge bite out of wealth every single time it skips a generation. And if you don't plan for it with absolute precision, it can just rip a family's capital to shreds. So that brings us to the core question, right? How in the world do you build a shield against a 40% tax that's just looming over every single generation? Well, the answer lies in a couple of really powerful interconnected tools: the Dynasty Trust and the strategic, and I can't stress this enough, irrevocable allocation of the GST exemption. So here's how we're going to break this down. First, we'll start with the why. What's the whole point of a Dynasty Trust? Then we're going to get into the mechanics, the IRS's default automatic rules, and more importantly, how you can take control and override them. From there, we'll walk through the actual paperwork on Form 709, look at some common and costly mistakes and how to fix them, and we'll end on the most critical point, the absolute, total finality of these decisions. Okay, first things first, what are we actually trying to build here? A dynasty trust isn't just any old trust. It's a financial fortress. Seriously, it's an irrevocable structure that's engineered to hold and grow assets for generation after generation. And in some states, that could be forever, all while being shielded from estate taxes and that punishing 40% GST tax. Now, the one number, the key metric that tells you if your fortress is going to hold, is something called the inclusion ratio. Just think of it like a vulnerability score. It tells you exactly what percentage of that trust is exposed to the GST tax. And for a dynasty trust, the goal is always, always the same. Get this ratio to 0. A 0 ratio trust means it's 100% exempt from the GST tax. Period. End of story. So, how do we get to 0? The formula itself gives us the answer. It's 1 minus something called the applicable fraction. Now, to get the inclusion ratio to be 0, that fraction has to equal 1. And how do you get a fraction to equal 1? The top number and the bottom number have to be the same. In our case, that means the GST exemption you allocate has to perfectly, exactly match the value of the property you transfer into the trust. Let's look at what this means in the real world, because the numbers are pretty staggering. Let's say you put $10 million into a trust. If you allocate a full $10 million of your exemption, boom, your inclusion ratio is 0. A $1 million distribution down the road to a grandchild costs 0 in GST tax. But what if you only allocate half? Now your inclusion ratio is 0.5. That same $1 million distribution suddenly triggers a $200,000 tax bill. And if you don't allocate any exemption, you're looking at a $400,000 tax hit. The stakes here are just incredibly high. So obviously, getting that allocation right is everything. To try and prevent people from accidentally messing this up, the Economic Growth and Tax Relief Reconciliation Act of 2001, you probably know it as EGTRRA, created a kind of safety net. These are the automatic allocation rules. But as we're about to see, sometimes that safety net can actually become a trap. Okay, so these automatic rules have two basic flavors. First, under Section 2632B, you have direct skips. This is super simple. You make a gift directly to a skip person, someone like a grandchild, and your exemption gets used automatically. But for dynasty trusts, we're almost always dealing with Section 2632C and indirect skips. This is when you put assets into a trust that could one day benefit a grandchild. The money's not going right to them, but it's on a path in that direction, so the IRS rules kick in. But here is the critical catch. The automatic allocation for those indirect skips only happens if the trust is legally defined as a GST trust. Now, the law presumes that it is a GST trust unless it fits into one of these really specific, narrow exceptions. For instance, if the trust is set up so that its assets have to be included in your child's taxable estate, well, then it's not a GST trust. And this distinction is huge because it means that automatic safety net is gone. You have to manually allocate the exemption if you want to protect that trust. And that brings us to the next logical step. Since those automatic rules don't always do what you want, you absolutely have to know how to take the wheel yourself. Sometimes you need to prevent an allocation. Maybe you're funding a trust that you only want to benefit your children. And other times you need to force an allocation where it wouldn't happen automatically. And both of these actions require you to make an affirmative election on Form 709. Now, to opt out, you can't just check a box somewhere. Under Treasury Regulation 26.2632-1, you have to attach a formal election out statement to a timely filed gift tax return. And this statement has to be super precise. You've got to identify the trust and the specific transfers, whether it's for this year or for all future transfers, that this election applies to. This is an active decision, not a passive one. And yep, you guessed it, the reverse is also true. If you've got a trust that does not meet that statutory definition of a GST trust, but you want the automatic allocation rules to apply to it, you can elect in. And this also requires a very specific statement attached to a timely Form 709. You're basically telling the IRS, hey, for allocation purposes, treat this as a GST trust. Okay, time for the main event, the execution. All this theory, all these rules, they all become reality right here on Form 709, and specifically on Schedule D. You can think of this schedule as the engine room where this irrevocable election gets formalized and all the math gets done. So, the whole process kicks off with Part 1 of Schedule D. This is basically just a roll call. You're listing out all the potential generation skipping transfers that you've already detailed on other parts of the gift tax return. The goal here is simple. You're just getting all the relevant players onto the field before the real action begins. Now, Part 2 is arguably the most critical section on the entire schedule. It is the balance sheet for your lifetime GST exemption. Line 1 starts at the maximum amount available. So for 2025, that's $13,990,000. But Line 2 requires a really painstaking review of every single gift tax return filed since 1986 to account for all prior allocations, both the automatic ones and the manual ones. This reconciliation is what tells you exactly how much exemption you have left to work with for the current year. And finally, Part 3 is where the math happens. This is where you formally take your available exemption from Part 2 and apply it to the specific transfers you listed back in Part 1. The form then walks you right through calculating the inclusion ratio for each transfer, which is what ultimately determines the final tax liability if there is one. This is the moment of truth for the election. So, given how complex this all is, it should come as no surprise that mistakes happen. And when they do, the consequences can be, well, enormous. The good news is the IRS does provide paths to relief, but it's really important to understand the pitfalls first. So what does a mistake actually look like in the real world? It's pretty simple, actually. That financial fortress you thought you were building? It suddenly has a giant hole in the wall. A trust that was supposed to be 100% tax exempt can become partially or even fully exposed. And that unleashes that 40% tax on every single future distribution to a grandchild or other skipped person. And here are some of the classics. Wasting your exemption on a trust during an estate tax inclusion period, or ETIP, when that allocation isn't even effective yet. Forgetting that small, maybe even unreported, crummy gifts may have been automatically chipping away at your exemption year after year. An IRS audit revaluing an asset can retroactively blow up your perfect allocation. And of course, there's just simple preparer error, checking the wrong box, forgetting to attach the right statement. It happens. For years, if you made one of these mistakes, the standard procedure was to ask the IRS for what's known as 9100 relief. Well, that's changed. The 2024 final regulations made it crystal clear. Relief for missed GST elections now has its own special path. You have to request it under Internal Revenue Code Section 2642G1. This means a formal private letter ruling, and you have to prove to the IRS that you acted reasonably and in good faith. It's a higher bar. And that brings us to our last and honestly our most important section. The entire reason that all this meticulous detail matters so much is because of the permanent binding nature of this allocation once it's been made. You know, the code itself is completely unambiguous on this. Section 2631B states it plainly. An allocation of the GST exemption once made is irrevocable. Once the due date for that Form 709 passes, that is it. There are no do-overs. You can't change your mind, you can't take the exemption back, and you can't reallocate it to a different trust. That decision is set in stone. And really, that's the bottom line. This financial fortress, the one that's designed to protect a family's wealth for a century or more, is built brick by technical brick on the perfection of this single form. So given the absolute finality of the election and that 40% tax just hanging in the balance, the question you have to ask yourself on every single one of these returns is
Is every single line item perfect?